I think you can take a snapshot in time, maybe a 1 or 2 year period, looking at some standard moving average levels and see if the stock actually reflects that it relies on those. You know, if you find
Welcome back, traders and investors. We have Scott Redler on the line. He's Chief Strategist at T3 Live and T3 Trading Group. Scott's been trading equities for 10 years and has an insightful, pragmatic approach we're going to talk to him about today. How you doing this morning, Scott?
I'm doing great. How are you?
We're doing good. We're doing good. Give us a little bit of your education and your background in the markets and how you ended up at T3 Live.
Well, I've actually been in the markets since graduating from college. I've been trading since about 1998. And I started as an old school day trader, momentum trader back at Broadway when pretty much everyone left their jobs of becoming from a lawyer to the doctors to the to the policemen. Everyone thought they could get rich in the stock market, and we all know how that what happened there. So from that point, a lot of traders all left that probably shouldn't have been traders. So what we did that stayed, we educated ourselves. And we pretty much educated ourselves in technical analysis and took some courses, went out to California, did Investors Business Daily course. I find Willie O'Neill's process very good. I've been studying it for a long time, and then I've created my own process as I've seen 9/11. I traded through the financial crisis. I've traded through bull markets, bear markets now, and at this point, I feel like I've seen mostly everything, except recently we've obviously seen the age of the computers, the age of them pushing the envelope every which way through areas to stop the shorts and through areas to get guys out of their lungs and basically make it people feel as pushed around as possible. But I just think that markets can still be navigated, rules still apply, and I pretty much pride myself on my game plan and my discipline and putting myself in a position to be prepared for every single day based on the complexion of the market. And I use different styles depending on, what's transpiring and what's taking place. I could try and get as much out of the markets as I can.
Do you come in with like predetermined levels of where you're going to act in an issue and just try and take the emotion out of it and say, have these levels determined in front of you or on your indicators and you say, and just be patient and wait to act? Are you a kind of trader that likes to, take a shot off the opening, with risk or rewards? What's I'm sure you got a lot of different styles. You talked about trading bull and bear markets. It seemed like we have a bull and a bear market sometimes in the same day. But let's talk about your approach.
Well, I'm in my office every day around 6:30, and I put together a morning note that goes out to anyone who wants to subscribe to it. And in that note, I come up with levels of different sectors, the leading sectors, the lagging sectors, depending on what's going on. I'm writing down different moving averages, different supports to see, what holds, what doesn't. I'm also writing down a list of about 20 stocks of names that I trade, usually the fastest moving stocks, whether they're ready to break down or whether they're tight, ready to look to break up. Recently, when we had this corrective phase, I would come in every day and I would, first things first, I mapped out when we broke the 50-day at 1960 and then tried to play a bounce off the 150-day at 1925, then knew where the 200-day at 1904 was, and then tried to map out what a 10% correction would be, which took it down to about 1810. And then more recently on the snapback, I tried to figure out, could it stick? Are people going to short the rally? Can we get some upside potential? So right away, this Friday we had that gap up after the double bottom Wednesday, Thursday, and the capitulation fear. So Friday was like a positive step where you had a gap up and it held. And then Monday took back the 200-day. If the market was that weak, the S&P probably shouldn't have taken back 1906. And then yesterday you had, the best day in multiple years, which probably wasn't a great day for traders because anyone who bought in the whole last week probably sold early, and some people who tried to be cute and fade the rally maybe around 1895 or 1910, they probably got a little scared yesterday and capitulated out. So I try and be as prepared as I can each day and figure out if something happens, what does that mean to my trading day, and how can I either stay risk averse or profit from a calculated situation.
Do you trade pretty much the same stable of stocks every day, or the ones that you're familiar with, the big boys that move, or do you kind of do you try and play the news and something off earnings and do your analysis off that? What do you prefer to do?
I typically have about 20 to 30 stocks that I map out every day. It doesn't mean I trade them every day. I try and create like an A, B, and C list. Which ones have the best, most calculated setup? Because I'm a manual trader, so it's only so much time you have from the open and putting in orders and whatnot. So I tend to have those 20 to 30 stocks, and when there's a good setup, I'll circle which ones I'm going to focus on the open. If there happens to be earnings or news around one of the names I'm very familiar with, whether it's Apple or whether it's Google or Facebook or Twitter, those are the names I try and gravitate towards. Lately, I've been watching Baba a lot. I do trade the financials when they're in play. Last week, I never really focused on the oils, but since that was the obsession of the market, I was trying to find the bottom in the XLE and the OIH. Now that they bounced, I'm probably going to put them on the B and C list. So it all depends what's going on. What I would suggest is, trade what you're comfortable trading, get to know the speed and the action and the composure of it, and then, when it's set up, move it to the top of your list. So this way, it takes up the proper real estate on your screen, because although I think I have 6+ screens, not everyone has that many, or if you do, you have 2 eyeballs and you have to execute pretty quick. So if you're prepared with those levels and you have your A list plays in front of you, you tend not to miss as many things as you would if you weren't as prepared.
You kind of took a question right out of my mouth. You said that you're, a manual trader, which, few of us dinosaurs are still around. You don't have any automated trading systems, anything from your strategies that you've developed that you've, because I know I've tried to automate and have not been successful at it. Have you ever tried it, or is there anything that you're currently running?
Well, T3 has multiple businesses, and T3 does have an IP division where there are programmers. I personally don't do that. I'm not on the programming side. I manually do my own strategies and my own setups. A lot of people have said to me, why don't you put a computer algo on the Red Dog reversal? It feels real calculated, and it's a great play with a very limited risk setup. Whereas, it takes the thinking out of it. I might focus on 2 or 3 of the Red Dog reversals where the computer could pick up, 70 of them, and then actually take the emotion out of it and ride it longer than sometimes I do. But I personally, my bread and butter is manually trading. But T3 does have an IP division, but that's separate.
Can you give us an example of the Red Dog reversal? Either from last week, or I'm sure there was a lot of them there. But could you explain that what it is, and perhaps walk through an example of it?
Okay, so let's talk about the XLE, for instance, where the group got battered and bruised. XLEs came from 100 all the way down into the low 80s. So people were trying to buy trade a bounce. Some people were still short, and what it is, it's a pivot level that I think is pretty emotional, where you break below a prior level. Okay, after a multiple day directional move in that direction, some people think the direction continues lower. So some people are shorting below a prior day's low, and some people are trying to play a bounce. So when it trades through a prior low, okay, and then comes back above it, it creates a great action area because shorts are trapped, and guys that were long just got stopped out, so they want to get back in. So typically you buy once you get back above that prior low with the stop at the day's low. So if you look at the bottom last week on the OIHs, there was a nice Red Dog reversal when it went below. To say, let's see, what day was the bottom? The bottom was
Wednesday. Well, Tuesday we went down, and then Wednesday we went back down again. I'm not sure. Let me pull it up on my.
So Thursday it held above it. Wednesday you made the low. Okay, so it did a Red Dog reversal on Wednesday. It broke below Tuesday's low, came back above it on Wednesday. So you bought once it came back above Tuesday's low, because if you remember on that Wednesday, the XLEs were actually green, while the S&P was still red, and so were some other sectors, so it showed a little relative strength. Then on Thursday, when Gartman said we're in a bear market, and so did most of the major people on TV, it held higher, and then you had a nice move since. So it was a great day trade that day if you bought it at that level, and then it was also a good swing trade if you said, I'm not going to sell it unless it breaks Wednesday's low, which it never did. So that became either a good day trade and potentially, a good swing trade if you watched the rules and said, I'm going to stick with it as long as it stays above that. the OIHs did the exact same thing. The OIHs made a low, and on that Wednesday came back above the prior day low, which was Tuesdays, and then Thursday on that dip didn't make a new low, so you could have held it, and now it's $4 or $5 or 8-9% above it. And then just say for today, because I might as well keep it as relevant as possible. Look at the spiders, for instance. Okay, the spiders just went from 182 up to 194.07. So today, I'm thinking if we can get some digestion or a pause, there's been a lot of people shorting this move, and who knows, maybe it can continue. Maybe we need to go to 196 first around the 50-day and retest that broken trend line from this year, which broke then. But you don't know. But in order to get to 196, it's got to trade above yesterday's high of 194.20. So sometimes what it'll do is, if it's just, I'm not exactly sure where we are now, we were flattish before, it'll trade through 194.20, just say go up to 194.70, and then come off of it. So some chasers come in because they missed the rally. Some people who've been short since Friday say, oh my God, we're going to go higher. I can't take it anymore. They cover. And you come back below 194.20, and then you say, ooh, we might put a little bit of a topping tail or a fishtail top. I call that the red dog reversal. You short 194.20, you put a stop at today's high, whatever it was, just say, example, 194.70, so you have 50 cents risk on the short side versus just rolling it up and trying to pick a top. And, then maybe we get a retracement and we come back down to test, 192.60, which would be, a decent trade, $1 and change, or maybe even test yesterday's gap or go sideways for 3 to 4 days and work off the oscillator that's plus 70 now and the RSI that's screaming because we're very overbought. So for me today, I'm going to look for some red dog reversals because I think we just went 6.5% off the lows. I tried shorting a little bit yesterday, a tiny bit early, but I think that's fine. It made some sense. And today, if we get a calculated one, maybe you catch yourself a cute short, but I do think the better trade will be seeing where we pull into and trying to buy some of the best acting stocks, because there are a few of them that held upper moving averages while most indices broke theirs.
On the trades with the OIH and the XLE on the red dog reversal, one thing is it's a non-emotional trade because you know where you're out. Right, you have
exactly.
Yeah. So that, I think a lot of times with traders, when you're taking a shot on things like that, it's a calculated risk. But if it went back to the low, stopped you out by a couple pennies or whatever, hey, that's the name of the game. So I think it's really great to emphasize, having a reference point takes the emotion out of the trading because you're out. The second point, when you were talking about, the spiders and, shorting, Dennis and I talk about this with stocks. A lot of times a stock will have a key level where there's big institutional sellers. And if you go in with them at that level, a lot of times there's it gets through that level, you get a little shake and bake, it goes up another 10 or 15 cents. But sometimes if you wait before it comes back down through that level, at least you're going in the direction of the trade. And you just illustrated that well with the spiders. Just one more thing on the on the red dog reversal. So do you take a big enough position so you can book some profits right away and then kind of move it over to your swing trade account? Or do you have separate accounts that you do your day trading in, separate accounts for your swing trading, and obviously I'm sure you have different accounts for your long-term investing. How do you let a day trade, or do you just keep it in your day trading account and trade it that way, or do you try and do a red dog reversal in the swing trade account?
I try and do it both ways. Like I do have a longer-term accounts with the wife, okay, which I try to recommend not people touch. Keep putting your monthly funds in, especially if you're 40 or less. You'll be fine. We've lived through a lot of different crises in the last 10, 20, 30 years. But anyway, as far as the red dog reversal, I do have an active trading account and a swing account. So I do try and trade them in both. And some people who don't take overnight risk, it's a great spot because there's action there. Like you said, it goes back and forth, back and forth. It's like a rubber match. And then depending on who wins the rubber match, you have a calculated entry. But typically, it's at an inflection point where it gives you a bigger trade. So you could do it as a day trade and as a swing trade, and I do try and do it in both accounts. Sometimes I try I do the same thing in both accounts, and it's not a clear active or one's a swing trading account. Depends on my mood. But now that maybe we just had the big move, off the lows, 100 handles, and if we digest well and I see relative strength leadership, I'll go into a portfolio approach and try and hold 6, 7, 8 stocks that now are above their 8 and 21 day, showing momentum strength. And then in my active account, I'll just trade for cash flow based on chart patterns. But that red dog reversal could definitely be a day trade and a swing trade. And I think people who put it on in their swing accounts last Wednesday, Thursday, and just trailed it the whole way up probably did better with it than me, myself, and I, because I'm also the offensive coordinator of my community as well as running routes on the field, and sometimes I wish I run my own routes better.
Yeah,
but people could.
Yeah, I can echo that sentiment. Okay, tell us about T3 Live and T3 Trading Group and the services that you offer there.
All right, well, T3 Live is an education platform where we have multiple subscription-based products. One of them being a virtual trade floor, where you could become a subscriber to that and see what 7 or 8 of the major contributors like myself are buying and selling, and see our positions live when we put them on, when we take them off. So you can actually see us execute on our game plans and then do it as well if it's part of yours. There's also about 400 plus people in a chat room talking about what they're seeing. So it gives you like those 800 eyeballs versus your own. That's a premium product, and it's probably one of our most expensive products. You then have Off the Charts, which is a newsletter that goes out nightly. So just in case you're not a full-time trader and you just want good setups, it'll actually tell you a good setup and push you out, when it happens. So this way it's like an action alert plus. You could be at your job, you get, Evan just sent me an alert to short this or buy this. You can put a bracket order in with whatever whatever provider you use to execute your trades. Or lastly, my product that I do every day, it's called Redler All Access. It's a morning note. It's pretty cheap. It's either, depending on when you buy it, it's $200 to $300 for the year. What you get there is a note that has what I'm thinking about the market for the day, the 20, 30 names that I'm looking at with levels of interest and some thoughts, and whether they're on my A, B, or C list. And it gets in your inbox by 8:45, so you could read it. It's like a one-pager and gets you prepared for the day if you're a professional trader. And then I also have a private Twitter feed, so I can answer questions about it, because my major Twitter feed has like 27,000 followers, so my private has about 1,000, so I could see your answers, your questions, and we could be a little bit more intimate. And then there's also a video that I do with Brittany that is a visual of my morning note, because I go over what I put on the morning note with charts and with her. She's very pretty, so it's a good visual. And so there's a lot of different types of products based on what you're looking to get out of the market, and some of them are all different price points, and they're all on T3Live.com. You can go to T3Live.com and see what's best for you.
Okay, and just to end it, I know you've worked with a lot of different traders on the education end of things. What would be the best advice that you could give someone that wants to get into the markets, wants to do some shorter-term trading?
I would just say educate yourself and start slow. It's not going to be a get-rich-quick scheme. There's no holy grail on one particular way to do it. Everyone has their own process, and everyone has to create their own routine, a routine that works for them. And you got to start somewhere, and start slow, and start with people you trust, and take your time, and have the proper resources to have the long-term viability of it. Don't go start an account with a few $1,000s and think you're going to make hundreds, and it's not going to happen. You need to start small. You need to build. You need to grow. You go from trading 1 or 2 stocks to 10 stocks. You need to go from trading 100 to 200 shares to a few thousand shares, and it takes time. I've been doing this now 13, 14 years, and I still have so much to grow on, so much to learn. And even yesterday, I felt real bad about myself because I sold my stocks too early, and I started short at the end of the day. And you come home from work, your mom listens to 10 Wins, and she says, "Oh, you must have had a great day," and you didn't. It can get to you. So you also have to do things on the side. Like I like to run races and triathlons for charity. It helps give me some balance to blow off some steam. So you're not judged by your P&L every day. You're judged by life, because that is really what will give you the longevity that you need versus red and green bars.
Okay, a balanced approach to life and trading. Scott Redler, Chief Strategist at T3 Live and T3 Trading Group, sharing his trading strategies with us. Thanks a lot, Scott. A great interview, and we hope to have you back on again.
Thanks for having me, and it's been a pleasure.